Now, when you're looking at investing in securities in the public markets, there are three major types of risks that you need to pay attention to. The first type of risk is called market risk. And this just means the risk we've discussed over and over, which is that the stock market will go up and down, and the bond markets, with nothing to do with your company. So for example, during the crash in 2008, Apple, Facebook, Google, all these phenomenal companies crashed a huge amount, lost a lot of value, even though they were fine. It was because the market crashed. So that's called market risk. The second kind of risk is called security risk. That is finding the best company that's actually a well-performing company to invest in. So the risk of the company itself. Security risk. The third kind of risk we're going to look at is called concentration risk, and that gets back to the too many eggs in one basket. How do we handle market risk? Well, we have to accept market risk. If you're going to invest in public markets, you have to realize you're like a little boat sailing on a very big ocean with very big waves. You cannot influence the direction of the market. Your boat just has to go up and down and ride the waves as things happen. So that's number one. You have to remember that you have to have a long enough time horizon, as we've discussed, in order to invest in equities, because they will go up and they will go down. But luckily, the overall direction is up, up, up over long periods of time. And third, you have to accept that if you want to make more money, you're going to have to take risk. There is no free lunch, and so part of making more money is taking more risk. Now, how do I handle security risk? Well, the best way to handle security risk is to pick high-quality securities. Now, how do we know if something is a high-quality security? Let's think about high-quality mutual funds. How do we tell if a mutual fund is good quality? Well, we can look at the Morningstar ratings, which are on Yahoo Finance, which we discussed earlier. Any fund that has been rated 3 stars or more, the ratings are from 1 star to 5 stars. 3 stars or more, it's probably a pretty solid fund. If you want to learn more about the Morningstar rating system, you can look here. You want to research your investments and understand the good and bad, because research is the best way to protect yourself. Understanding and looking into the details is how you handle security risk. What about if I just want to buy a single stock or a number of small stocks instead of a mutual fund? Well, there are things you can look at in the company that will help you determine if this is a high-quality security. Does the company have strong revenues? Strong earnings, which means the money they have left over after their expenses. Does the company have a lot of cash on its balance sheet? Does it have a high cash position? Are there many admirers to the company? Do a lot of stock analysts say it's a good company? Does it have great growth plans? Is it in a growing industry? And does it have good social impact? Let's look at one of my favorite examples, which is Amazon. The ticker is AMZN. We all know Amazon. We can order online and get all sorts of things delivered right to our homes. Now, Amazon has $177 billion in revenue, $65 billion in operating profit, and $20 billion of cash on its balance sheet. And through July 2018, this year alone in July, that stock is up 45%. I would say that's a high-quality security. Now, what are some warning signs that a security is not high quality or is changing from high quality to lower quality? Well, the first one is the price of the stock is going down. The company cuts the dividend payment of the stock. Management has terrible scandals. We've seen a lot of that lately. People leave the company, or in the investment analysts, instead of recommending that you buy the stock, recommend that you either only hold it or you start selling the stock. Let me give you an example of Bank of America. The ticker is BAC. Now, Bank of America for many, many years was one of the strongest stocks in the S&P 500 in the United States. Many people relied on its dividends, particularly retirees, to live on, and it used to trade at around $50 a share. Well, at the time of the recession, Bank of America got into a lot of trouble, made too many loans, had bad mortgages and things like that, and they had to cut their dividend. They went from being a $50 a share stock to $5 a share stock with no dividend. So those investors who had Bank of America had their investment go down to 1/10 of its value with no income. That is an example of a stock that is lost, gone from being a high quality stock to a low quality stock. Now, what about a high-quality mutual fund? A high-quality mutual fund will have 3 or more stars from the Morningstar rating agency. Typically, will have over $500 million in assets in that fund. And they will have strong performance over at least 5 years, unless it's a new field that hasn't existed for 5 years, for example, artificial intelligence. And they will have good performance when they're compared to other similar funds. You can find a good list of well-performing mutual funds at the U.S. News and World Report Fund Ranking list here. Let me give you an example. The T. Rowe Price Growth Fund, whose ticker is TRBCX. Morningstar ranks this fund with 5 stars. It has $53 billion in assets, and it's a growth stock fund for U.S. growth, and in over 5 years, it's returned 18.76%, whereas similar funds have only returned 13.82%. So high rating, lots of assets, lots of growth, and performs better than other similar funds. Now, what are the warning signs that a mutual fund is getting into trouble? Well, first of all, if people start selling the funds, which is called large outflows from the mutual fund, that is a bad sign. If Morningstar reduces the rating or the number of stars it gives the fund, if Morningstar reduces the rating or the number of stars it gives a fund, that is also a bad sign. The price of the fund might go way down, or if the fund has bad performance compared to other similar funds, sell it and find something else to invest in. Now let's talk about concentration risk. What is concentration risk? Well, it means you have concentrated your portfolio. You have put too many eggs in one basket, you're taking too few investment bets, and so if those few bets that you're taking go wrong, you're going to be in trouble. Now, how do you manage concentration risk? It's simple. It's called diversify. Spread out your risk. Make sure your ETF or the fund that you're investing in also is not too concentrated. For example, if a fund had 60% of the fund in just one stock, that would be way too concentrated. It's better to have many eggs in many baskets.